Welcome to your single source for insight, inspiration, and unfiltered conversation in financial services. In each episode, we'll talk to the disruptors driving innovation, unpacking the market trends, strategies, and the stories behind the numbers. Follow and subscribe to stay at the forefront of global finance.
Good morning, good afternoon, good evening. Thank you very much for joining us and into what is going to be a fascinating conversation. Well, let me set the scene first. My name is Bhaskar Dasgupta, and I'm the chairman of the board for Apex in the Middle East and India. Now, we've been talking about how can we do some more interesting things, and what better than to start talking about books. For a confirmed bibliophile like me, the idea about having the official opportunity to read quite a lot of books and then decide on the best absolutely tickled me. So we decided to launch what I would call as the Apex Book Prize for the best financial markets, and specifically within the asset management side, simply because Apex has got such a wide footprint in the asset management. We look after about $3.5 trillion worth of assets. What better way to actually start saying, besides just looking after your funds, here's a great book you should read. So just as a bit of engagement. So we decided to launch it, and this is the inaugural year. And we have partners from Global Custodian and the winning entry, which give me a moment, we'll announce it in a moment. But let me pass it over to Richard, my colleague, for his introduction and background.
Sure. So my name is Richard Schwartz. I've been writing for Global Custodian for a long time, editing the research products, and co-founded the sister title, The Trade. And traditionally, we've covered all the downstream activities from investment decisions. So really the plumbing of the investment world. And this was a good opportunity for us to move upstream to the people who actually need the service that we write about. And we might even use some of the book shortlists to give to our new journalists so that they understand the area that they're covering. And that's about all I think you need to know about me. So over to Sebastian.
Great. Thank you very much. So let me welcome Sebastian Mallaby, who is joining us for the book that we have selected. Sebastian, a quick introduction to yourself, please.
Sure. Well, I'm very happy to be here. I'm Sebastian Mallaby. I'm a senior fellow at the Council on Foreign Relations in New York, where I cover international economics and finance. I've written a number of books. 5 have been published. One is with Penguin right now, and will be coming out in 2026. And the one that's been selected here, which I think we're going to discuss, is a 2010 book called More Money Than God. And it's a history of the hedge fund world from inception in the 1950s all the way through to the 2008 crisis. And, writing has always been my passion. I was a journalist at The Economist magazine on the staff there for almost 13 years. I was on the Washington Post editorial board team in Washington writing about economics and finance for about 8 years. And now I've transitioned into book writing. It's all great fun, and I love talking about it.
Great. Thank you very much, Richard and Sebastian. By the way, Sebastian, I'm very jealous of your book rack behind you. That is absolutely amazing. So we just thought that, no good deed goes unpunished. So me and Richard are going to grill Sebastian on the book and some of the background and sort of, bring it alive a bit. So we're going to have a series of questions for Sebastian. So let me start. Obviously, Sebastian, you have spoken about power in many forms: central bankers, venture capital, hedge funds. Why the hedge fund world for your book? Well, what drew you to this?
Well, one of the things was that when I conceived the idea, along with my editor at Penguin, in around 2006, 2007, hedge funds were widely viewed as the craziest frontier of finance, the most risky, the most scary. There were politicians in Germany calling them cockroaches. Long-term capital management in 1998 had blown up, a famous leveraged sort of fixed income derivatives trading hedge fund. And that almost, caused a global financial meltdown. The Fed in New York got involved in the resolution. So there was a lot of feeling that hedge funds were the scary part of finance. And I had this intuition that in some ways, if you didn't like too big to fail banks, then small enough to fail hedge funds, which were not generally backstopped by taxpayers or governments, were a much better place to put risk. And anytime you can see, an argument which you find convincing but is totally out of consensus, you had varied perception. That's a fantastic opportunity to try and move the dial in terms of public perceptions. And it just so happened that while I was doing the research, of course, the 2008 crisis unfolded. And sure enough, insurers went bust, investment banks went bust, money market funds went bust, auto companies had to be rescued, hedge funds, they failed, sure, but they didn't have to be rescued by the taxpayers. And I think it vindicated my intuition that a small enough to fail hedge fund is way better than a too big to fail taxpayer-backed institution.
Great, thank you very much. But again, I'm chairing one of the large hedge funds, and also arranging for a roundtable with about 40 of the largest hedge funds in Abu Dhabi. And believe you me, it is so difficult to get them to open up. But you managed to do it amazingly. So what was the secret? How did you manage to get these guys to open up and point to perhaps one or two interviews that really changed the book's direction or your initial thoughts?
Well, you're right. That was actually the second reason to do the book, is precisely that they don't typically open up. They were private, and they like to stay private. And to an investigative journalist, of course, that's the most tempting possible subject to try to get into. And I think, my method, which I've now repeated, with other books, is partly just patience. If you take the time to build trust with, anybody who's hedge fund adjacent, and then they introduce you to other people who are hedge fund more adjacent, eventually you'll see the hedge fund people, and you will do so with a set of, warm recommendations that do encourage them to speak. And then I think it's important to walk into the meeting demonstrating that you've done 110% of your homework, that you've really, if they've done a single interview with a media source, if they've been on any kind of radio show or podcast. Back in the day, there weren't so many podcasts, but any public appearance, you have studied that, internalized that, and your questions are trying to build on top of the foundation, not just to get them to repeat what they've done before. And that both demonstrates, that you're worth talking to because you've done the homework, that you're serious, that you really want to understand. And then, I think people, in fact, do like explaining what they're up to, how they generate alpha, how they come at that, how their ideas about alpha have changed over time. And, part of what I'm trying to differentiate myself against is, I think, a media which is possibly a bit too gotcha, a bit too kind of, keen to go on the attack. I want to understand, explain. I'm happy to criticize if I think it's warranted. But the first mission is to explain the generation of alpha, not to, rant about the evils of capitalism or something.
Yeah, that sounds good. One thing that you said, the trust. This is going to be telecast to somewhere around about $4.5 trillion worth of allocators sitting in this room with about 60 to 70 managers. And I keep on saying you move at the speed of trust. So I think your point about them trusting you enough to, divulge their innermost secrets is amazing. Well, let me hand it over to Richard for his set of questions. Richard.
Sure. I'd just like to make one small comment. I tried to interview one of the people who gets a passing mention in your book, and the furthest I got was he said I could come for a cup of tea, but he didn't speak to the press. So I'm a bit envious. One of the themes in your book that runs through it is the dividing line, if you like, between skill and luck. I mean, all the people that you cover have had good days, good years, bad years. Do you think there is a discernible line between skill and luck, and has it moved over the past few years, particularly with things like data-driven decision-making tools and quant activity?
Yeah, that's a great question. I mean, I framed this issue a little bit based on the sort of thought experiment that if you had, 10 monkeys throwing darts at the stock chart, at the end of 5 dart throws, you'd have 1 or 2 monkeys who got lucky and hit the right spot on the chart. And those monkeys would think of themselves as very intelligent, and they would go to cocktail parties with other monkeys, and members of the opposite sex in the monkey tribe would find them very attractive, and they would tell stories about their genius, right? But actually, in any distribution of 10 monkeys, there's going to be a couple who get lucky, right? So that's the sort of thought experiment that leads people to say, well, you shouldn't take, traders, speculators, hedge fund managers too seriously when they have good returns, because some of them were bound to do so. Well, that is kind of statistically true over a short period. It's statistically false over a long one. If you've got a hedge fund manager who generates, strong returns over quite a long track record, the chances of that being lucky are so vanishingly small that it becomes pretty perverse to say, oh, that was just luck. It just isn't. Now, once you've decided, okay, when I see returns over a long period, that's actually a skill, then the interesting thing is to figure out, well, what was the skill, right? And it's not always obvious even to the practitioners themselves. And here, to take another sort of, analogy, McEnroe, the famous tennis star from the 1980s, would be asked, why is your topspin forehand so devastating? Is it because you move your wrist early over the ball to get the spin early, or is it the follow through? What is it? And McEnroe would give a theory about why his topspin was the best in the world. But if you filmed him and you slowed it down and you watched clip by clip what he was doing, his explanation of his skill didn't resemble the actual skill. So it's the same with traders. Paul Tudor Jones famously hired a very kind of computer science friendly trader to sit next to him, watch him, try to interview him every time he did a trade, and really track and analyze what the nature of his skill was. And it became impossible. You couldn't program into a system a formal replica of Paul Tudor Jones, because his own explanations of what he was doing in any given trade didn't actually explain why he made money. And yet he does make money, right? And so I think you have to get underneath the surface a bit and, figure out what's really going on. I think in the case of Paul Tudor Jones, I concluded that it's sort of a prepared mind story. That prepared mind is an idea I find coming up in a lot of different areas where a lot of skill is involved, which is that, I think Paul told me, if you sit in a room the night before, the next morning's trading, and you just quietly say to yourself, well, what are the things that might happen in the market tomorrow? What are the possible responses to those things? And you just game through the different scenarios so that you're kind of prepared. So that accelerates your decision making the next day because you've seen the options before. Those are kinds of some of the training which don't deliberately, it's not a sort of, well, I know that, interest rates are likely, spreads will tighten tomorrow or something. It's more a set of mental preparations. So it can be quite subtle things like that. I think on your question about systematic trading, computerized trading, sure. I mean, there, the human element is taken out and the computers are doing the trading. The algorithms are, sort of knowable, although if it's an AI type of, self-training system, it's a black box and even the programmers don't know what's going on. So you could say there that the skill is hard to put your finger on. But I think it does make it more repeatable and predictably repeatable, which is why you've seen this trend of more and more allocators shifting into algorithmic traders because it feels more comforting that there isn't a kind of key man risk where you're betting on a sort of human individual's intuition, which is so hard to put your finger on.
Was your opinion about that line different at the end of the book from when you were preparing it and researching it? Did you change your mind at all in the process of writing?
I think I began sort of genuinely open-minded. I wanted to understand, how hedge fund traders made money. I didn't have a lot of priors. And one of the fun things, I'd say the biggest change by the end of the project was I understood that in some ways there are very basic commonalities between lots of different hedge fund strategies. The ability to go both long and short means that you can hedge out because of your shorts. You're hedging out, types of risks that you don't have an opinion about. So you may not have an opinion about the general macro environment. You may not have an opinion about, the stock market as an index. But if you're long one car company and then short the other one, you're taking a very narrow, specific bet on the relative quality of, the management team and the technology in one company versus another. And you don't care if the market as a whole goes up. If you are, not net long, you're neutral on the market, but you have a strong opinion on this relative value trade between two different companies. And then because you've screened out a lot of the risks you don't want to take, you can leverage your bet without it actually making it more risky, right? Because, you've taken out a lot of risk first by hedging, and now you're putting back some risk with the leverage. So it's that ability to kind of home in on the risks you do want to take and avoid the risks you don't want to take. That I think is the commonality in lots of different hedge fund strategies. But then at the same time, as we know, there is this richness and diversity around, are you long short equity? Are you a macro trader? Are you an event-driven person? Are you a distressed debt trader where, the skill is kind of just to understand bankruptcy courts and bankruptcy judges? Are you an algorithmic trader? There's just so many different things that you can be doing as a hedge fund trader. But I think they have these commonalities. I didn't foresee that before I began the research. That was one of the interesting things I came away with.
And one last question before I hand back to Bhaskar. One thing that's happened since you wrote the book is the development of these massive multi-strat, $100 billion funds. Does the size of the fund make it more difficult to be consistent in your the success of your chosen strategy?
I think there's a big distinction between, asset aggregation in the hands of one trigger puller, which definitely is a problem, right? If you have a good idea, but you've got just tons and tons of capital, there's probably only so much capital you can put to work in that idea before you've traded out the opportunity. The prices move because of the weight of your own money. And so you're not going to move the needle on a large amount of money with, a fixed number of ideas. And so giving more and more money to one trader or one strategy is a bad idea. But the multi-strat funds, the whole point is that you take a large amount of capital and you slice it up between lots of different people who are making these decisions. And then, in fact, you can dynamically adjust between these different traders. And that feels to me, logically, it would work, right? Because you've taken the overheads, the back office hassle, a lot of the compliance hassle, which is significant. You've centralized that at the level of the multi-strat company, but you've left the trading decisions to these smaller pools of capital that are operating under that umbrella. Logically, that would work. Empirically, it seems to work. These guys are doing very well. So I think that's just a good invention. The danger comes in sort of what I would call the amaranth problem, where you have a particularly persuasive trader underneath the multi-strat umbrella, and that persuasive trader, manages to get too much capital allocated to his strategy, which is what Amaranth did with natural gas, and then they failed. I think it was 2006 or thereabouts, as I recall, 2003 perhaps, around there. And so multi-strat had become too much like single strat because one particular trader was generating so many returns. So you have to have disciplined, centralized allocation philosophy. But I think the good multi-strat funds have that, and they're doing very well.
It's okay. Bhaskar, over to you.
Thank you, Richard. Sebastian, I just wanted to unpack a bit more about the people. I know you talked about Tudor Jones. You obviously met quite a lot of people there. Who surprised you, and why?
I mean, one interesting thing is that the stereotype of the speculator, the hedge fund crazy person, right? Which is that they're kind of, wild characters who are, slinging money around, is quite pervasive. The stereotype, one of my favorite books about finance is The Money Game by somebody with a pseudonym, Adam Smith. And this is a portrait of the 1960s bull market in Wall Street. And in The Money Game, he has this line about, sideburned gunslingers, the young traders who came into the Wall Street market and just had no sense of risk. They'd never seen a bear market. They were just like, the day traders of the modern era. Hodl, hodl, YOLO, all those phrases we learned from the recent period. This was the 1960s version, right? But actually, the people I met as who are traders are cerebral, normally very calm, sometimes quite introverted. The stereotype was 180 degrees of what I encountered for the most part. Now, I think Paul Tudor Jones has a cowboy gunslinging side to him, even if he doesn't have any sideburns. Last time I saw him, so he was a bit of an exception. There's a hilarious video documentary that was made about him, where he plays the sort of risk hungry badass. I'm going to scare my opponents in the market by just throwing so much money they're going to just be blown out of the water, this kind of macho talk. But he really is the exception. I remember going to see Lewis Bacon, another famous macro trader from the same vintage as Paul Tudor Jones. And the funny thing was, I got to his office and there were kind of 2 or 3 screens and some figure behind them. And you had to kind of look around the screen pretty much to get him to make eye contact because he was fairly much of a loner. And indeed, the joke about Lewis Bacon is that when he made a lot of money and bought himself a private island, it didn't matter. He was so insular already, right? And this is the polar opposite to the character that you typically meet when you write about venture capital, which I've also done in a later book, The Power Law. So there, in venture capital, the security you want to buy is actually an entrepreneur, and that entrepreneur has 2 legs and can run away if you're not relatable. So you got to be a people person in venture capital, whereas a lot of the people in hedge funds are kind of more introverted data people. And that was a surprise. I think a surprise to some of the readers as well.
Well, I hope you're planning a second edition of that book. So I guess the follow-on question would be is that if you were to do the second version, edition rather, who else would you prefer to see in that book?
Well, I mean, I wrote a little bit about Ken Griffin and Citadel in my book, particularly in the 2008 crisis. There was a sense that Citadel would follow Bear Stearns and Lehman Brothers and go out of business because a lot of its style was quite investment bank-like. But it didn't go out of business. It survived. I believe that was because it knew it didn't have any kind of backstop from the government. So it had negotiated lines of credit to protect itself in this kind of very stressed market situation. So it survived the 2008 crunch. I think if I was to write a sequel today, Ken Griffin is basically emerged as the most successful entrepreneur of his generation if we take out technology entrepreneurs, right? I mean, he has built Citadel, the hedge fund, and Citadel Securities, which handles something like a quarter of daily trading volume in US equities, not to mention enormous amounts of derivatives and other instruments. And so I think it's just an amazing story, how long he's been at it, how successful he's been, and so forth. I think another trend, which is in my book, in its nascent period, is the sort of D.E. Shaw, Renaissance technologies, quantitative, algorithmic trading. And the quants have clearly grown, as we were saying. Two Sigma would be one example of an amazing firm that wasn't really a thing when I was writing and has become a major thing since I wrote my book. And Two Sigma, gives rise to a set of questions about what a hedge fund is, because traditionally the hedge fund is just the people. It's just the general partners. And when they retire, there's no fund left. And there's no business that you could sell on. But if you're building algorithmic trading systems, computer scientists can be hired to replace the ones who left before, and you're kind of accumulating value in the systems. And so there is enterprise value in the hedge fund kind of operating company, which is a new thing and gives rise to questions like, could you go public? What's the enterprise value as distinct from the human value? So those are just a couple of ideas and things I would write about. I think thematically, the other big thing, of course, would be to grapple with the period of quantitative easing. It's my belief that if a hedge fund is a company that is paid to price risk, and then risk spreads are compressed, not surprisingly, the hedge funds make less money, lower returns, because you could be right on, which instrument to be long, which instrument to be short. But if the spread between the instruments is so compressed because the central bank is printing money and buying assets and driving down risk spreads, it's not profitable anymore. And that's indeed what we've seen with lower hedge fund returns in the period between the '08 crisis and COVID. My thought now, therefore, is that in a new era of higher inflation, higher interest rates, enormous demands for capital from AI build-out, which is going to drive up interest rates globally. I think real rates are higher, nominal rates are even higher because of inflation returning a bit. We're in a world where hedge funds are poised to do better again. That's my prediction. So I want to grapple with that.
So I'm going to hand it back to Richard for his final set of questions. Richard?
Okay, sure. As Bhaskar mentioned at the beginning, you've chronicled venture capital, hedge funds, and central banks. If you were looking ahead and trying to trace the locus of financial power in the years kind of coming up, what would you be keeping your eye on? And I don't know if your new book has anything to do with that or not.
Yeah. I mean, the new book is about artificial intelligence. It's a story of DeepMind, which is the Google subsidiary that builds the Google AI. So depending on your view of the horse race, you might say it's the top AI group. You might say it's second after OpenAI, whatever, maybe they're equal. But anyway, the story I tell is of DeepMind, founded in 2010, before AI could do anything, right? In 2010, AI couldn't recognize a picture of a cat. That didn't come until 2012. So the story of DeepMind is the story of modern AI, and that's what I'm narrating in my book, which comes out in 2026. It's sort of related to your question in the sense that although this is not a finance book directly, clearly AI is driving financial markets right now. And I think understanding the technology, understanding where the people come from and how they think is pretty important to parsing the biggest question in financial markets right now, which are the valuations remotely sustainable or not? I think if I was to look beyond that, and here I might be trailing another book I might write, is that I think if you to put technology aside and say, well, what's the biggest change in American capitalism since the 1980s? I would say clearly it's the rise of private capital, right? A finance professor in 1983 or 1985, if you said to them, look, I know you like public markets. I know public markets produce liquidity, produce price discovery, produce an element of transparency so that society knows what corporations are doing. But despite all these advantages, public markets are going to be eclipsed. And you're going to get more and more of America Inc. owned and managed by private equity. And then there's going to be this single private credit that comes up alongside that. Most finance professors would say, well, this makes no sense. But that's what's happened. That's the story of the last 40 years. And so I think trying to explain what the heck happened there is a fascinating intellectual puzzle. And again, there's going to be an amazing story, I'm sure, of the individuals who drove the private equity story, how they generated alpha. I feel like that's an interesting theme.
And last question from me. The title of the book, More Money Than God, what does that mean in practical terms for the rest of us? I mean, is it a question of what do you do with it? Is it power? Is it freedom? Is it responsibility? What does it mean for the world, if you like?
Yeah, I have to say this title was not popular with the industry. I mean, I almost called it the Alpha Game, which is in fact the title of the introduction in the book. But I went with More Money Than God because I kind of focus grouped it with my editor, my agent, my friends, and it felt catchier. And of course, it's legitimized by a couple of points in the book where this phrase is used by people. And it was an early thing about how, one of the first hedge fund managers, somebody said of him, well, he's richer than Apollo or something, or one of the Greek gods. I forget precisely, but, more money than Apollo, more money than God. It felt like a fair phrase to use. And to some extent, if hedge fund managers can't deal with the fact that society regards them as people who have more money than God, then maybe it's a healthy wake-up call to call my book that and confront them with how society actually does view them. What's the responsibility? I mean, look, I think actually that the main responsibility for hedge fund managers is to run good hedge funds, be good stewards of capital, bring efficiency to public markets. This is an underappreciated kind of public good, right? I mean, it's fantastic that a retail investor can go into the stock market or into the bond market, buy a security which will be priced fairly because of the arbitrage that hedge funds have done, and then sell it when they want to at a fair price because of the arbitrage that hedge funds have done, and also, by the way, the liquidity that they bring to the market. And a lot of people say, oh, liquidity, what is that even? And it's like some abstract, rationalization for the existence of speculators. No, it's actually a real thing. A generation or two ago in the US, if you wanted to buy or sell a security, you would pay a $30 trading commission. You would have, much slower settlement. I mean, you know this, Richard, you're the expert on all this plumbing. And I think the plumbing matters, right? And I think hedge funds facilitate that. So I'm happy to say, if hedge funds do a good job of managing money and making good returns, by definition, they're creating liquidity, they're creating price discovery, they're being good stewards of capital for their LPs. This is good, right? And I think at the margin, you could say, well, yes, and they should pay more tax on their carried interest. I support that as well. But I'm not really into saying, you have a responsibility sort of to, I don't know what, give X percent of your money away to charity. I think that's up to you. I think that's personal. I do believe in inheritance taxes, but I don't believe in micro prescribing what individuals do with their earnings.
Okay, thanks a lot. And now back to Bhaskar for some quick fire questions.
Thank you, Richard. So, Sebastian, these were pretty good open-ended questions. So thank you for those answers. Now, some quick ones, if you will. The most misunderstood hedge fund manager.
Whoa. George Soros. George Soros is now vilified in his country of birth. He's vilified by the political right. He is not really understood, I don't think, at all.
Good point. This you should have fun with. The most overrated financial innovation.
The most overrated financial innovation. Goodness. Okay, I would say it's growth equity, meaning growth funds investing in unicorn technology companies. These growth funds are super popular. Money is pouring into them. They back these unicorns and deca unicorns and, $500 billion valuation for OpenAI. I am not a fan of this kind of investing because there's no governance on the companies that they invest in, right? They put money in. They do not go on the board. They say to the founder, you've created a unicorn, you're a genius, we'll do whatever you say. And I think that all human beings, whether they are investors or, by the way, writers, they need an editor. In my case, they need, if you're an entrepreneur, you need an investor who goes on your board, or in the private world, and that you need some corporate governance. And in the public markets, you kind of have that, because if the managers mess up the company, then short sellers will sell the assets, or activist hedge funds will show up and campaign for change. And so managers are held to account. In big technology unicorns, managers are not held to account. And I think that leads to a misallocation of capital sometimes.
Fair enough. And we obviously rely on financial journalists to tell us all about it. Who's the financial journalist that you most admire, my friend?
I would say Andrew Ross Sorkin of the New York Times is, right up there. He's prolific. He runs Dealbook, the column at the New York Times, which is very good. He's on TV nonstop, and he's just published what I expect is going to be a fantastic second book. The first book was Too Big to Fail, which was really a great book, and the new one is 1929, a reconstruction of the inside story of the 1929 market crash. So I would put Andrew right up there.
Following on from the book point that you made, the book you wish you had written.
Well, you could sort of cite some of the same books, but I'm a fan also of Roger Lowenstein, and his book, When Genius Failed, which is about long-term capital management, was really an inspiration to me when I wrote More Money Than God. It's just a fantastic, sort of serious-minded attempt to understand how long-term capital management put its trades together, what the theory was, why the theory went wrong, who the people were. It's not kind of shrill and judgmental. It's just really good.
Great. And the last question, if you could give one sentence of advice to the next generation of investors, what would it be?
I think, differentiate yourself. You will never make money by following consensus. So you need to develop some non-consensus viewpoint, which of course has to be based on very serious research. There's no point being non-consensus and wrong. But if you're non-consensus and right, that's where you're going to do well. And in a nutshell, that's the objective of good investment.
Great. Thank you very much. So here we go. Sebastian, thank you very much for the time that you have taken, and Richard for your pertinent and cogent questions. I hope to the audience, you had a bit more of an inside peek into what goes into the making of an absolute award-winning book. Thank you very much for your time.
It's been a great pleasure. Thank you both.
Thank you.
Thank you for listening to The Single Source, brought to you by Apex Group. If you enjoyed today's conversation, be sure to follow and subscribe.